Okay, let's make our accrual for depreciation at the end of the cycle to recognize the fact that office furniture and equipment is less valuable at the end of the year than at the beginning of the year. It's pretty simple. Notice that they give you what the amounts are. Just be ready. I mean, if it's $33,000 and it has a 10-year straight line, then you would take $3,300 a year. If it's 54,000 straight line over 10 years, it'd be 5,400. Just know that straight line means whatever was paid for it divided by that number, 10 years, 5 years, whatever is what you take per year. So in this case, we're going to take, it just gives you what it is. So this is pretty easy entry. Oh, I do want to point, it says make a compound entry. What that means is don't make one depreciation expense account entry, make one for each one. So you'll see here in a second what's meant by that. So you got depreciation expense, well, let's do it in order here. Office furniture, equipment, we'll go ahead and put our amount in. Office furniture is 3,300. Then 5,400. And then remember when we recognize depreciation expense, we don't, this is a non-cash entry. We're not crediting cash. We're not paying for it. What's happening is we're hitting the contract count. The contract count is accumulated depreciation, office furniture, accumulated depreciation, equipment. Remember that the accumulated depreciation account is a contra account. It basically shows the outside world that the asset that you have on the books, the book value is not, you can't take it in isolation. You have to subtract the accumulated depreciation. So 3,300, 100, 5,400. And what we're doing here is to record depreciation expense. And you see here depreciation expense for office furniture, for equipment, accumulated depreciation. On the balance sheet, it would show, let's say, for example, the cost of the office furniture. Let's say let's say it cost, I don't know, $50,000, whatever. This would slowly start eroding the net book value of that, because every time you look at the cost of 55,000, whatever, you have to subtract from it the current balance in accumulated depreciation. So that means little by little, this accumulated depreciation account will get higher and higher and higher as you book more and more depreciation expense. Assuming there's no salvage value, that it's worthless at the end of the 10 years or whatever the magic number of years is, accumulated depreciation will equal the cost of the asset and its net book value will be zero. This is an example of booking depreciation. Depreciation, like a lot of these is a non-cash item, but you have to adjust for it to show the outside world, hey, our assets are not worth as much, they're slowly depreciating, and you want to put that through the income statement. You'll notice depreciation expense goes through the income statement, and accumulated depreciation ends up in total on the balance sheet. I hope you found this useful.